Firstly, to make money in trading means to repeat things over and over again, meaning that those who can repeat things can make a lot of money in this business. However, what we will be repeating must always be the same for us to have consistent results. You cannot be someone who is adding today and dividing tomorrow. You need to be on one track. If you are into multiplication, you must remain like that. That is the same analog to this particular business. In this video, we'll go through a setup that repeats over and over again and is highly accurate, and those who understand and master it will definitely see some results. And anyone, no matter how experienced you are, novice or experienced, this setup will definitely put results in your pocket easily. You'll be able to find this on almost all tradable setups. So for those who will be asking, does this work on indices? Does this work on volatilities or crypto or currencies? This setup repeats on almost all tradable setups. If you're new here, consider subscribing and turn the notification bell icon so that you won't miss any of our videos. Firstly, we are going to talk of liquidity, because liquidity is what moves the market. And this is why we see ups and downs on our charts. So this setup you are going to learn about will require you to understand the concept of liquidity. This is a common term and you've probably heard about it before. Big banks or market makers who we try to mimic within the markets cannot trade like what you and me do. I imply that you and me are all retail traders and they do not or cannot be able to trade like what we do. They have access to large amounts of capital, say 100 million, say 50 million, and if they just press buy or sell with millions of dollars, their orders will not be filled. Unfilled orders is actually a loss to them because it will not allow them to execute at the rightful price and time they intend to take. This is one of the disadvantages of trading with an extremely big capital. There are, of course, several more disadvantages, but this one is a major one, so that you cannot just press buy or sell at your will. So what do? They actually create the liquidity. Liquidity creation is actually a process whereby they create the buyers and sellers themselves that they will counter the trade with the trade they intend to take. So say they want to buy and they intend to buy, they will definitely induce traders to take shots, and there are several methods to do so. This is done through a lot of methods. Actually, they have a module on liquidity creation. When you get into hedge fund trading, you have to learn liquidity creation. So one of the methods is to create a panic narrative, as they have access to big news sites and influential market analysts. For example, the Federal Reserve. In the third quarter of 2024, there was this trend whereby everyone was actually talking about the Federal Reserve cutting interest rates. It was actually something that was giving a scary environment whereby everyone was actually going against the US dollar. We actually saw the US dollar tanking for the war quarter. And soon when the Federal Reserve announced the interest rates, we saw this market or the DXY going to the upside. Was that a coincidence whereby we can have a long period of drop and just before the announcement we see an opposite move to what has been announced? So basically they create a panic narrative or a scary narrative whereby traders start to sell or start to buy depending on that particular narrative. Another way is to hit stop losses of retail traders, as they can see all these orders and intentionally lower or rise prices to those prices. So it's a process whereby they actually can perform what we call cyclic trading. You buy from me and I sell to you. You sell to me, I buy from you. It's actually a cyclic trading whereby they will be performing it amongst themselves. And when they are doing so, price will tend to move to the price point they intend to take. So if we now understand that liquidity is the dump money in the market, we can now apply the following setup to take our share. But before we talk about that, we have this indicator called the BTMM Pro. This is for those who are actually finding it difficult to get entries. This will send signals to your phone, and it is highly accurate. You can see these are the example of signals that it issues, and these were issued on EuroGBP. Another one that was issued yesterday from the time of recording this video on gold. It was actually a buy, and it actually gives you highly accurate. You can get your copy using the link that I'll leave in the description box below. All right, back to the video. So if we understand that market makers require liquidity, it will be wise for us to enter at the same points. If we manage to enter at the same points, it means we are moving with the big sharks or moving with the big banks. We must become market maker stalkers, and below are the signs for us to see their hidden tricks. Firstly, we talk of accumulate, expand, and shift. Anyone who is definitely going to grasp this concept and be able to apply it will find the market very easy to trade, and will find it very easy to get winning entries. The title explains it all. I've just said accumulate, expand, and shift. What is all that? Those who are patient to recognize the accumulation phase, then the expansion phase, and enter before the shift will definitely make money. Everything we will talk about goes down to this arrangement. But how? That's your biggest question. Let me explain. Firstly, there is what we call market pockets. The market we trade is made up of these pockets. These pockets are periods of operations. When we look at market makers, they do what we call shifts. Shifts like what happens in factories, whereby there is a morning shift, an afternoon shift, and a night shift. These shifts are responsible for different things within the markets. So they come as trading sessions. We do not talk of shifts, but we are now talking of sessions, which I am referring to as pockets. They come as trading sessions, trading days of the week, or trading weeks of the month. So we are saying these pockets are sessions, days, or weeks, or even months. And if we are going to be trading as investors, we can talk of pockets as years. In each pocket, market makers have an agenda to fulfill. They may pick a session, any session, or any pocket to fulfill the accumulation phase, or a day, or a week, whatever the pocket they choose. The arrangement of accumulation, expand, and shift must be done. So, your job is to find the accumulation pocket using the following principle. I'll give you a principle that will simplify how you are definitely going to see these accumulation phases as the initial pocket of operation. So, to understand that, you need to grasp this golden principle. You actually need to write it down so that you understand everything that I'll show you later. Accumulation phase is a session, or a day, or a week, or a month where its opening price is equal to the closing price. So we are saying we have a period. If the opening price is equal to the closing price, no matter what happened in between, we do not care. What we care is the opening and the closing. If this happens, we attain the accumulation phase, or we attain the accumulation pocket, so that we start our arrangement of accumulate, expand, and shift. So the principle states that when an accumulation phase has been recognized, we expect to see an expansion move which go to the high or low of the accumulation as shown below. I'll show you how this arrangement will look like. So basically, this is the summary of the arrangement of how it comes. Accumulation, expansion, shift. The opening price and the closing price are almost equal. You can see it's almost a straight line. And then whatever that happened in between, sometimes it might spike like this. We do not care. Then after that, we need to see a move which we call expansion that goes to either the high or the low. If we consider trend, or basically the previous period, if the previous period was actually rising, we'll expect to see a move of the expansion phase to the low. If it was dropping, we expect to see a move of the expansion phase to the high. So the expansion phase is basically a move to the high or the low, depending on whatever the trend of the previous period. After that, at the bottom part, that is where we look to make our entry, which comes as candlestick reversal patterns. If you find an engulfing pattern, that will be much more powerful than any other candlestick reversal pattern. And then the shift phase is basically a move away from these points. So these zones, from this colored zone that I'm coloring, this is where we actually look to have liquidity. This is where several stop losses, this is where several traders are actually getting to wait to go for breakout trades. So these points are highly accurate if you manage to get them. Right, everything that we explain needs examples, and examples are there to concrete and give you a platform to comprehend everything that you'd have learned. Before we go to the market examples, check out our free Telegram channel. I'll leave the link in the description box below. Example 1, this was on Euro GBP H1 time frame. We can see there were several days. So what I want you to see is, can you see that this was an opening price and this was the closing price of this particular day? This opening and closing were almost equal, meaning that this was an accumulation phase, right? That is the first job. You box the accumulation phase, you wait for the expansion phase. The expansion phase was issued. Here was the expansion phase, right? We can say this was an expansion phase or this was the rightful expansion phase because the trend is actually going to the upside. Therefore, the expansion phase was issued down right below to grab the liquidity below these lows. And then the market went to the upside like that. This was an H1 time frame, meaning this was a day of consolidation or a day of accumulation. Day of accumulation, expansion, shift. Day of accumulation, expansion, shift. Then we had Euro GBP again, but now on the M15 time frame, where we are now looking at intraday movements, which are movements within a session. Can we see that the opening and the closing price of this Asian session were almost equal? Therefore, this was actually a session of consolidation or an accumulation session, and we had an expansion phase, which was this one going right below this session, and then we can see the shift, right? Like that. The trend was actually in an upward direction like that. Then can we see this one was now USD against South African Rand on the H4 time frame. H4 time frame actually gives us periods equivalent to weeks. We had this opening price almost equal to this closing price for this particular week. So if we had this opening and closing price for this week, it means this was an accumulation phase, right? So an accumulation phase was issued, and after that accumulation phase, we had this expansion, right? Going right to grab the liquidity above this expansion phase. Then can we see the market later moved in our direction? So I am going to just summarize. We are saying it's accumulation, expansion, and shift. Accumulation, expansion, Then shift, accumulation, expansion, and shift. Make sure you hold it by heart. Put it into your assegai of twos. And if you do so, you will definitely see that you have much more accurate trades. On that note, we have come to the end of our today's video. Thank you for watching, and check out this video to further your knowledge.